Welcome back to Callistofx, this series called The Only ICT Concepts You Need to Know. This is the second episode, and today we will be talking about mitigation blocks. First off, what are mitigation blocks? Mitigation blocks are a type of order block where buyers or sellers mitigate their orders when they are in drawdown and price comes to their break-even point or near their break-even point. How do we identify mitigation blocks? This will be from a swing failure pattern, and the mitigation block itself is either the low or the high of the swing failure pattern, depending on whether it's a bullish or bearish scenario. And then we will be talking about how to use mitigation blocks to trade. Let's talk about a bearish scenario first. What does a swing failure pattern look like in a bearish scenario? When price reaches a higher time frame resistance point or premium point, price pushes down. And buyers over here will be looking for price to go back up to this swing high. But this low fails to take out this swing high. What do I mean by that? This low over here pushes up price but fails to take out this swing high, hence the name swing failure pattern. What happens is when buyers place their buy orders here, they expect price to hit the resistance point or the previous swing high, hence they will be holding their position even when price reaches here. However, they realize price reverses and they are in drawdown, and this is what we call buyer's remorse when price comes back to this level over here and they get to mitigate their buy orders. That's why our point of focus will be this area over here, and this is where us traders, us ICT traders, can go for a sell order. When price returns to the mitigation block, we can place our sell order here and we can go have our TP at the support or discount area. Next, let's discuss the bullish scenario. It's the same thing as the bearish scenario, but it's just flipped around. Instead of buyer's remorse, it will be seller's remorse. Right here, price goes to a higher time frame support or discount, and we see price being pushed up. This swing high over here fails to take out the previous swing low. Therefore, when sellers place their sell orders here and they target this swing low right here, they get into drawdown first. And when they realize they are in drawdown, they will look for price to return to the mitigation block to mitigate their orders. Once again, we'll be focusing on this area over here. Same thing, once price returns to this mitigation block, we can look for longs, targeting the resistance and having our stop loss somewhere at the mitigation block area. Let's look at our real life chart examples. Let's take a look at the bearish scenario. I have a few pointers on the top right, so it will be number 1, our swing failure pattern, number 2, our mitigation block confirmation, number 3, return to the mitigation block, and lastly, our entry. So right here, we have this swing high at a point of resistance. This will be our resistance zone over here, and we have this swing high. Price dips down. We have buyers over here that are looking to break this swing high, but price pushes up and fails to take out the swing high, and we have a further push down. When the buyers at this level realize they are in drawdown, they will mitigate their orders at the mitigation block over here, and this is where we would look for sells. So when price returns to this mitigation block, we'll be looking for sells covering the mitigation block, and then we will be targeting a previous resistance area somewhere here. This is just one example of how you can use mitigation blocks in the same time frame to trade. Now let's take a look at a bullish example. Right here, we have a swing low and then the swing high. If you were a seller, you would be selling at the swing high, expecting price to get taken out at the swing low. So that'll be where you set your take profit. However, price fails to take out that swing low and there's a continuation higher. In this case, where our mitigation block is right here. And when price dips back down to this area over here, the sellers will be looking to mitigate their loss. Hence, we can have a buy position at our mitigation block, covering the low of the mitigation block and targeting the highs. Of course, in hindsight, you'll be able to get much more out of this trade, but just to be safe, targeting the swing highs will give you a relatively quick and easy trade. Let's recap what we went through this video. First off, we went through what mitigation blocks are. They are a type of order block where buyers or sellers mitigate their orders when they are in drawdown and price comes near break even, and how these mitigation blocks are formed would be through a swing failure pattern. And we also went through how we use mitigation blocks to trade. We need to wait for price to return to the mitigation block, and then we can place our entry dependent on a bullish or bearish scenario. If we're looking for buys, our mitigation block will be a bullish candle, and if we're looking for sells, our mitigation block would be a bearish candle. I hope you enjoyed this video and found it insightful. insightful. If you did enjoy the content, please remember to like and subscribe to the channel. We'll be continuing this series with many different PD arrays and how to incorporate these ICT concepts into your trading style. I'll see you guys in the next one.